How is the mutual fund market today? Paying a load is akin to throwing away most or all of the supposed advantage you get from having a salesman choose a fund for you. If it's true that asset allocation accounts for 95% of investment results over long periods of time, then only 5% is left over as a reward for having the right fund and the right manager. But even if a salesman could help you pick that right fund, paying him a commission of 5% wipes out the benefit. When you pay a 5% load, you lose the opportunity to invest 5% of your money forever. When you buy a load fund, the money that goes to the salesman goes to work for him, not for you. When you invest in a no-load fund, all your money goes to work for you, and load percentages are always higher than the quoted figures. For example, in a $10,000 investment, if $500 goes to the sales organization, then $9,500 is invested on your behalf. Funds are allowed to call this a 5% commission. In fact, you invested only $9,500, and the $500 load amounts to a commission not of 5% but of 5.26% on your real investment. Load amounts are higher than they look. The effect of your commission grows over time. If you avoided a $1,000 commission by investing in a no-load fund over 25 years, you would wind up with nearly $11,000 more if your money compounded at 10%. In other words, the $1,000 load would in effect be an $11,000 load. The broker who chooses a fund for you may have a reason to prefer that you buy a poor-performing fund instead of a top-performing one. Studies show that funds operated by brokerage houses have poorer average performance than independent load funds. Yet a broker often earns exotic trips and other perks in addition to a higher percentage of the commission for selling house funds. So if you buy a load fund from a broker, at least insist on getting one that is not managed by that brokerage house. You'll then get more objective guidance and hopefully better performance. On average, load funds charge higher expenses than no-load funds. These are the expenses that all funds take out of their assets, whether their investors pay loads or not. In a study that covered thousands of funds, Morningstar found that the average load fund charges its investors significantly more than the average no-load fund. Expense ratios among equity funds averaged 1.1% for no-loads and 1.6% for load funds. Among bond funds, the average was 0.6% for no-load funds and 1.1% for load funds. Those differences may seem small, but unlike a load of funds, expense charge hits you year after year after year. The longer you own a high-expense fund, the deeper it reaches into your pockets. You shouldn't necessarily keep the fund either. If the fund has a back-end load, that provision may give you an incentive to leave your money in that fund. Sometimes back-end loads are structured so that the longer you leave your money in the fund, the lower the load. You should study the prospectus to find this out, or have somebody help you with it. Or call the fund and ask about your options. Don't keep a fund just because of its back-end load. Even if you keep a back-end load fund long enough to avoid most or all of the load, the salesperson still got paid the commission. The fund found some way to extract that money from you to cover its commission cost. This could account for some of the higher expenses that load funds levy on their shareholders. And of course, you may be hit with annual 12b-1 fees to cover marketing costs. If this is the case, then you may be paying those fees again and again every year you own the fund. In summary, the presence of a load is not reason enough to sell or keep a fund. The decision depends on the details of the load, your own circumstances and needs, and the quality of the fund itself.